Okay. Okay.
Yes, sir. All right. So basically, like everybody know, like I've been using that quarter theory for US 30. So like 30, 35,000, 35 250, 35 500, like so on and forth, forth. Like basically you just go every 250 pips. So what I noticed this morning, again, I've been just trading models lately. So like I come in 8 to 10 is my trading time, and I'm just trading a specific model. And the model that I like to see, again, I have the chalk and flip model that I like to see. I have my OTE model, and then for indices, a lot of the time I've been seeing this happen a whole bunch. Basically, we're like structure is being made in the market, and then you have like an identified ranging area that starts to accumulate, and then you have basically an accumulation grab, and it'll come back and retest and usually take off. So usually this is what you're looking for, is this bottom level to basically be taken out. And once this bottom level is taken out, you can take this as distribution and then get your entry either coming from the top, coming out of this, you can take an entry and then have your stop loss below, or you can wait for the retracement back to this level, which is going to give you a lot more, like better risk to reward, and it's going to give you just better entries overall because you're actually going to wait for confirmation. But again, you at the end of the day, you know how like it's volatility. So like if you're trading at 8 o'clock or whenever New York session opens, you're going to have that volatility of New York session. So you know that either way, it's gonna move in a direction. We know that US 30 and NAS can move 1,000 pips a day. Like it's happened in front of our eyes. So like we have to understand that once we get a directionary bias, it's just about understanding where we at in this key level and how we're going to get our entry. So, these hiccups are killing me today. So basically that's why I have this time and price marked out. So we have the prices marked out here. This was 8 o'clock my time. So we have 9 o'clock marked up, which is 8 o'clock my time, which is when I start to look at the charts. So we see here, price comes down, or price is moving down. We're moving in between the key level of 34,000 and 33,750. So given that we understand where we're moving in, now we have to wait for some type of confirmation or something to be able to tell us like that we can get into this. So we know that structure overall is bearish. We see this is just from a 1 minute. Again, we know how to do top-down analysis. That's not what we're here for. We have our top-down analysis. We understand that overall structure is bearish. And we also understand that our opening candle has now opened bearish as well, giving us that bearish signature to potentially trade lower. Again, if we've, just like we've went over in the Zooms multiple times, you could have multiple other entries in here. You have an identified high, you have an identified low, and what does it come up to? This is 62%. Again, anything above 50% equilibrium is okay for you to take an entry to the downside. So above that 50%, it actually smacks the 62% here, and you could have got a nice entry there, understanding where you wanted to target and then taking it down to the lows. But that's just another way that you could have got identified entry inside of here. Other than that, we're looking at, again, bearish structure. So what we were talking about, that we have these key levels that are marked up. We see price come down and hits this level. What does it do? It hits this level and retraces. This is no confirmation to me. Again, you don't want to be hopping in. And this is why I say, like, it's a lot better to wait for confirmation. Again, break and retest, all types of things. It doesn't matter how you trade, harmonics, patterns. Every single time you want to get a confirmation. You don't want to just hop in a trade because a wick came down and then went back, unless you have a higher time frame confirmation telling you that wick came down and mitigated an area in order to go. Again, in this instance, we have no idea why this came down here. We know that it's a sweep of liquidity, but this is no identified range for us, so there's no trade here. So moving forward, we see that price action retraces back, and then we have this huge drop off here. So you have this huge drop off through this key level, and we have a little retest of that key level, and then a bearish sign lower. So here, again, you could have had an entry here, but this isn't, again, just what I talked about. This isn't what you really want to look for. You can play the key level straight up. You could have taken a short position here, and you could have been having your identified high as the wick to play your stop loss. Again, there's multiple entries that you can get inside of here, but we want to look for our most precise and most defined entries. So as we see, we have this bearish sig. We retrace the bears, or we retrace back up to our key level, and then we drop off completely through 35,500. Again, another quarterly level. Once we hit 35,500, what happens? We sweep the liquidity of our key level, and then we start retracing back up. So in real market presence, this is where, again, you can mark out right here your identified low here that swept liquidity. Again, we are still bearish. So I didn't take these two trades here. I did not take this morning. I was looking when I finally got onto US 30, it was over here, and this is the trade that I ended up taking. But given that we are in bearish structure, again, this could have been very hesitant to take because you're looking for sell side liquidity to be taken. But just like we were talking about here, what happens? We have a run of the lows. We have that accumulation that turns into distribution once we go and retest. And then what happens? We come right back down and we retest that same distribution multiple times before what? Taking out the next key level. And literally just by having this right here, this is just a 1 to 3. Just from having this identified range right here. So you're already targeting a 1 to 3 again in a couple of minutes on US 30, just off of taking this identified range. So what happens here? We have a bullish retrace back up. And then what happens? We sweep the highs of 33,750. Once we sweep these highs of 33,750, we have our identified high range here. And now this is the structure that I would mainly be looking for. Now this right here, it would be my most ideal entry. This entry would have been at 954, again, right in our trading time of 8 to 10. And this is a perfect entry to look for. For one, you have the confirmation of this, given that you have your high side liquidity being taken, you have your low side liquidity being taken, and you have equilibrium being traded into, and now you're running the 79% level. Again, this is why fibs aren't everything, because we do have this 70% level, but if you would have had an order here, then you would have obviously gotten stopped out trying to play the 79%, or if you wanted to play the 100, you could, but this is US 30. That's like 100 pip stop loss. There's no point in doing that. So rather than that, you can redefine it just like we had just talked about. A sweep of the highs, we see that sweep of the highs. We break down lower. What are we expecting? We're expecting a retest to where that mitigation turned from basically liquidation to distribution, the same exact thing, accumulation to distribution, same thing. We sweep the orders, and now we turn into sell side liquidity. So we sweep those orders of the highs. We have our order placed here. What happens? We tap into our order, and where's our next target? Well, obviously we're looking at key levels. So your next target could have been 35,500 for TP1. This would have ran you a 1 to 2.9. And then you could have ran the whole 1 to 5, which I had this marked up because, again, I have to target minimum 1 to 3 for my trading plan. So I would have just targeted the entire side range and then partialed out once we got down through here and let the rest run out risk-free. So there's a second, again, a perfect representation of how this just happened. First time, second time. Now, this is the entry that I actually caught this morning. So I was trading a little bit later. I had these alerts set because we've been bleeding all week. So I knew that although we were bearish and we had all of these bearish SIGs, again, I wasn't looking at this morning. I was looking at EU this morning. So I understood that we were bleeding, but we needed some type of retrace. We've literally on every other time frame, we're dropping out of the sky. So something has to retrace in order to give us proper market structure so that, again, we can either continue going bearish or we can start to see signs of reversal for us to start going bullish. So once we got to here, again, we have our key level 33,250. And I saw here that 33,250 was struggling to be broken. So as we see here, we struggled to break it. We retested back here. We struggled to break it again, but once we struggled here, we actually swept these previous lows and came back here. And then we also struggled again. Again, just like I was talking about, you want to see your entry from the break and retest. This is another model that I do have that I can trade off of, which is basically a sweep of the lows. It's the exact same model. Again, you have lows being defined in the market. You have lows being swept by a pool of liquidity, which that's what this is right here, a pool of liquidity onto those lows. And then again, what happens? We have a break and a retest right back to our same zone that created that accumulation that turned to distribution, because now we are looking for bullish signatures. So this could have been your potential entry at first, but again, I didn't see that. So didn't see that. Moving on, had to go to the next one. What happens? Just like we talked about before, this right here is all just the liquidity sweep. So we had that liquidity sweep. We finally got that bullish break, and that bullish break actually broke identified highs. We broke this previous high here. We broke this previous high here with a full body candle and with a lot of momentum. Again, another thing that goes into figuring out if you're in a good entry or not is speed, time, and price. That's what it comes down to. Time and price theory is basically just saying that you're going to trade at a specific time because you know that that's when your pair likes to move. And then at that same time, you also know that if your pair is wanting to move, then you want to see some speed in the market. You don't want to see a whole bunch of choppy candles back and forth on a 1 minute time frame and expect it to just pop for 40, 50 pips. Like that wouldn't necessarily make sense. You want to see speed so that you understand that you are on the right side of the market. So what do we see here? That 1 minute candle goes completely bullish, again, breaking those highs. That shows enough speed for me because, again, we've fully broken structure now, as well as the fact that what do we do here? We came back, we tried to retest. Again, like I said at first, we're looking, originally, my entry was 33,250. That's where I was looking to get an entry and pull back. But we have to understand what the market's doing. We had a whole bunch of accumulation here. And again, we still had that model that I just talked about of this sweep of the lows, which has already came back and retested. So it wouldn't make sense for this to come back and retest this zone because, again, that means that this would have been a failed break of the highs into mitigation and then potentially a push to the downside, which that wouldn't make sense for what we would want to look for. So what do we look for here? We have this bullish push of the highs. We have a retrace back down here. We see that we get stopped at this level. As soon as we get stopped at this level, now I'm looking at this level and I'm trying to figure out what we're going to start doing. I see we have a wick here. I see we start to retrace again. I see we come and we whip back down here. This was my confirmation here to get in. I got into this entry here at this bottom level wick once we retested on this third time. And I was looking, again, for price action to run the highs because I was expecting a retrace given how much we had fallen off at the beginning of New York session. So taking that, I just played the lows of this structure. And as soon as I played the lows of this structure, again, we just ran the highs. This is a 1 to 9 R. And again, on a higher time frame, you're probably like, oh, why don't you target TP1? Again, you can target TP1. This is a 1 to 4. Yeah, I always take partials at 1 to 3. I take 70% off the table. So this is already running you a 1 to 4 to first TP. But the main reason why we're targeting this 33,750 level is because if we look at structure, for one, we have very clean imbalances that are left up here, as we can see right here. And as well, we also have this order block that was previously filled that we know is most likely going to have a run on liquidity of this order block in order to either push us back downside, taking out previous lows, or what did we do? We ran this liquidity here, ran the liquidity of these highs, we retraced back down, and then now we're going bullish again. So again, market has to retrace. Where does the liquidity lie in the market? That's what you should be asking yourself every single time that you prepare to get into a trade. Where is the liquidity resting, and where are orders most likely to go and take out and be filled? Again, that high gets taken right here. That high gets taken. We need to retrace because we've already taken the orders from all of these highs. Where are the new orders at? There's orders here. There's orders here. There's imbalances here that can be taken out. So what happens? Price comes right back down, taking out all of those orders and imbalances before actually rallying to the high side because what's up here? We have more orders accumulated up around this triple top here. We also have a whole bunch of orders from this accumulation at this key level. And what happens? We run the high of the key level. And what do? Retested the key level perfectly right where these orders were before actually pulling more bull pressure. So it's simple things like that just, again, you can incorporate these key levels into your trading, and it can make it 10 times easier because once you understand market structure and everything like that, it just comes down to your entries and where you want to get in and get out of the market. Again, everyone relies on entries and talks about entries and things like that, but a lot of people fail to realize that take profit is probably more important than your entry. If you don't understand where you're going to get out of your trade before you get into the trade, then you're just like your hindsight trading. You can get into a trade. Like, think of it in this way. Once you get into a trade, you know that even the best traders in the world, like it's very hard to cut emotions completely off. You're always going to have some like distinct form of emotional attachment to any kind of money. It doesn't really matter. You're going to have some distinct form of it. So why not make your life easier? And instead of once you get in the trade, having to worry about where your TP is and all of that while you're already seeing your money fluctuate, rather than understanding what price action is doing before and understanding where you already want to look to be getting out of the market. And again, this is one of the things that has helped a lot with like just trying to hold trades and just trying to be more consistent, is that like when you actually have a place where you know that you want to target, again, if I'm targeting this 1 to 9 and I'm telling myself I'm getting out here, I'm taking partials at 1 to 3, but I'm getting out here. This is what I know. That means that I know my discipline. I know that before I get into this trade, I already know what I want to see happen. I already know where I'm looking for things to happen. I already know the specific time. Again, I don't know how long it's going to take, but I know that if we're trading in high volatility times, that our specific price range is going to be targeted in those high volatility times. So it's more likely to run these highs at these times, given that the beginning of New York was an absolute melting pot. What happens? Beginning of New York was a melting pot, leaving a whole bunch of liquidity for the end of New York to come and retrace and grab that liquidity back. Now, where are we at in the market here? Now we're up here in the market. Tomorrow, what do I expect? There's a whole bunch of liquidity down here that's resting. We could potentially go bearish and come and take this liquidity down, which would most likely be what I would be looking for in the morning. Or again, we could have a London spike and wake up and we could be starting to make bullish pressure. But if we understand where liquidity is lying in the market and we identify the ranges of where we want to trade in and where we want to get out, it makes things 100 times easier. And it's so much easier to get your executions, because again, this was a no drawdown at all. I had a 47 pip stop, which is beautiful for US 30 on a 1 minute time frame. Again, there's really no other identified structure that you could play here. Really, most people are going to try and play the order block for their stop loss and all. No, you don't need that, because again, we just broke down exactly why price action did what it did in front of our eyes. And we also broke down exactly why we want to look to be targeting the specific areas that we want to target. But that was the main US 30 breakdown from today. Again, that 1 to 9 was perfect, but I just going over, and this is why I said like we had to go over this today, because I just saw that like this happens over and over again. And given that I've been again trading that time and price model, just understanding that like if I don't get this set up, if I don't see the setup that I want to see, I'm not taking an entry. Either I'm getting a chalk and flip, I'm getting accumulation turn to distribution, or I'm getting an OTE entry. I have 3 possible entries that I can get. If I don't get those entries on the pairs that I'm looking for that day, then it's not a trading day. And we move on to the next day and we live to fight another day without losing any money. Like, and that's basically what it comes down to, and what you want to look for ultimately so that you can stay profitable. Another thing that I wanted to go over is I know a lot of people as well trade NAS. But the same exact thing happened on NAS this morning. So if we come and hop on NAS real quick, we can go through a quick breakdown of this. Where's 9 o'clock? So 9 o'clock here, which is 8 o'clock my time, where I hop on the charts. So we have this right here. So this is where 9 o'clock opens. We have this key level being tapped here. Again, NAS is different. I don't go quarterly on NAS. I go every 125 pips, because NAS moves a tad bit slower than U30, but it's still, it's a beautiful pair to trade. So every 125 pips, again, 14,250. So we see this low being ran here. Again, I already see potential places for entries here. But let's just go over it. We have this open. Our open is bearish. We understand price action just from a 1 minute time frame is bearish. Looking at it, we're already bearish, and our opening candle comes out bearish. So we already have that bearish sentiment for the day, and we understand what we most likely want to do with price action and market structure. So what happens? We have this low being ran of the key level, and then we have a complete rejection here. Again, if you just wanted to trade straight up key levels, you could be taking entries right here, trying to take these buys to sells. But again, we want to look for the most high probability setup. So personally, that's not what I'm looking for. So here's our first entry here. We see that we have our entry, or not our first entry, but our first potential entry here. So we see that we run these highs completely, we run our key level, and then we drop off. So what I would be looking for is to come back and test that 250 level, because again, that's the top of this accumulation that now turns to distribution for sales. So I would be looking for my potential entry to be right back here. What happens here? We don't get that. As we see, the market ends up running without us. And again, we're not going to chase an entry. There's no point in chasing an entry. There's going to be more entries to come. So that's just something that we didn't catch. We see the bearish stig going down, potentially going down. Now, what do we have here? Again, this isn't as defined, but it's almost the exact same thing. And if you have the seconds time frame, it's actually it's so clear on the seconds time frame, but I don't have the seconds time frame. So again, this is another entry that I most likely would have missed, just because, as you see here, just from a 1 minute time frame, this is extremely fast. But what happens? We have our lows here. We have us running the lows. Again, it does not matter how our lows are ran. We understand that we are trading time and price. This is New York session open, or around New York session open. What is this? This is 9:20 my time. So we're way past New York session open, almost an hour into New York session now. So we have the low that has been run here. Again, it is a small little run of the lows. That doesn't matter. We still just ran these lows. So what happens? If we run these lows, I'm potentially looking for that top side accumulation that then turns to distribution in order to take price higher. So you have an order that you could have set right there. Your stop loss could have been below here, and you could have been targeting the tops here. This is a 1 to 9 right here. A 1 to 9 that you could have called again on the retrace. We have our bullish pressure up, showing that we leave this accumulation turned into distribution, or retrace back into our key level, which also happens to be, again, accumulation, return to distribution, and then a run of the next key level, which is where you most likely want to be targeting. Because usually the key level, if you're just trading in between the key levels, you're going to get 1 to 3s most of the time. You should not be having like 1 to 1s trading in between key levels. That means that somewhere in here, like your entry is not tight enough, or you're not basically paying attention to the specific model, because you should not have like a stop loss that's, you shouldn't be catching things like this. Like that wouldn't make sense. Again, you know that the key level is getting run, and then you know that it's a retest of the key level, because that's where your price action is holding weight that you want to take to the next TP. So for here, that's a perfect 1 to 9 that you could have called. You could have been done right there. 95% of us are done for the day on a 1 to 9. And where's this entry at? This entry is at 9:22. So again, that 8 to 10 time frame window, when you really want to be trading, you're in that time frame. Perfect entry, 1 to 9, 9% on a Monday. You can't beat it. What do we have here? We have price action here coming and running these highs. We have a huge accumulation here. We have accumulation that is now ran. So now that we have accumulation that's now ran, again, the same exact thing can happen here. And this is why I say, like, it's so consistent and it works almost all the time. What did we just say before we even got to this right here? Again, you could have been taking this buy, but like I said, I would have probably missed this, for one, because of how fast it happened, and for two, because again, what is structure saying? Structure is bearish right now. Structure is bearish, and we're near New York open. We know that we're in a bleeding market. So what happens? We have this accumulation here that then turns to distribution. Once we run the lows, your entry point is going to be right there at that level. Again, stop loss above the high. Where's your first TP? Your first TP is right here. This is a 1 to 2.23. So this is one of those things that I'm talking about, where the model is it can work, but this is not what I would be looking to take. And I couldn't take this entry because, again, this isn't a 1 to 3. Now, yes, of course, I could be targeting these lows down here to target a 1 to 4. But in order to do that, you can't just look at the 1 minute in order to do that. You need to go on your 5, your 15, because you would have to know that there's actually liquidity laying down there from a higher time frame. You can't see that from a 1 minute. So that's just hindsight trading. And again, you definitely can't see this low down here from the 1 minute. Again, we can't see any price action over here. So yeah, you could potentially have caught this if you were on the higher time frame using your signatures for that. But this is a perfect way that, again, you can get the same exact entries, run of the highs, accumulation turns to distribution, retest, and then what happened? We eventually drop off completely. So there was the second one. Again, most likely would have missed that one as well. I don't like to sell indices, like I've said multiple times. So that is not an entry that I would potentially be looking for. But just to show you, again, it works every single time. What happens here? We have this low right here that is now ran. So you would be potentially what? Looking for an entry right here. This would be where your potential entry would look for. Again, you would have your stop loss below the low. You would be targeting the highs, but you would ultimately lose this trade. Again, why would you lose this trade though? If you're looking, what time is this? This is 11:49, which is 10:49 my time. Like I said, 8 to 10 is going to be your trading window. Yes, you can catch trades outside of your window. And yes, this model does work outside of the window of 8 to 10, but you are going to find your most consistent setups from 8 o'clock a.m. Central Time to 10 o'clock a.m. Central Time. That's where you're going to find your most defined setups and your cleanest setups. So again, if you were looking for a buy here, you would have gotten wicked out there and or not even wicked out. It would have just ran the lows for bear signature. Now, what happens here? This was at 11:17. Again, this was at almost the exact time that I took my US 30 buy as well. What happens? Key level 13,750. We run the lows of the key level. We then retest the highs. What happens? Well, first of all, this could have been your first entry. If you were looking at these lows being ran, you could have had a stop loss below there. And again, if you want to target the first target is a 1 to 3, so on and so forth. And this is how you just optimize your risk to reward going up from there. But what I would have saw here is that, again, this is a very fast-paced action. This is what you originally want to see. This is how you're going to catch the tightest entry. But what happens now? We go bullish, break our highs completely, which is what I like to see for the sign of reversal. Again, now we have smart money trend line. Again, all this is saying is that we have induced liquidity that has now ran the highs and also ran into a previous level of what? Imbalance. Again, all of the things that you learn from smart money and things like that, they all interact and they all go together when it's all said and done. Everything works together and everything can be used as an extra confirmation and an extra signal for you to be able to get into a trade and for you to be able to get out of a trade and make your daily, weekly, monthly goal. So we have smart money. We have a smart money trend here saying that these highs are being broken that also induce this liquidity. We also have these lows coming back down here. Again, just like we talked about previously on US 30, we have mitigation down here. So we have the accumulation that turned to distribution. So we already mitigated this area. If we see price come down here, we don't want to be in this. We know that it's most likely going to fall off because that means that first of all, smart money, the smart money trend would not be holding because we would have traded into this imbalance and now would be running more lows to potentially sell off more. And also, you know that given that this is already mitigated, we've already seen that this is mitigated. There's no reason for price to come and mitigate an area that has already been mitigated. That wouldn't make sense. So we have a low being defined here. We mark out that low. What happens here? Our next candle, doji candle, barely wicks below the low. Next candle, holding the high. Next candle, holding the high. Again, you can wait for all that confirmation, but all I see is this bearish candle, this bullish doji candle, and then this next bullish hammer candle. This is where I'm looking to get my entry right here. That next, because again, you can get an entry on any one of these wicks, but that's where I would be looking to get my entry because we have now 1 rejection, 2 rejection, and now I understand the hindsight of wanting to be on the bullish side of the market, given that we had our original entry that we would have missed here. So what do we do here? We have that bullish signature there. Again, you can play super tight and you can just play the key level like I did on US 30, or you could play it safe. Again, at the end of the day, it doesn't matter what you want to do. It's just about how you're going to find your profitability and what works best for your trading plan. So if you are to use that, if you're going to target here, this is a 1 to 1.5. So I wouldn't be able to do that. Again, for it to be valid for me, I would at least have to target this second zone to run me a 1 to 3. But again, you can redefine. You could have had your stops at the lows. You could have been targeting there. If you have your stops at the lows, then yeah, you can target the high because now that this becomes 1 to 2.9, almost a 1 to 3, but still not quite a 1 to 3. So it's not valid for me. Again, original entry, take those highs, lows are the stop loss. And now where do we want to target for our TP? So we have that first area here to run us our 1 to 3 that we have to target, along with understanding what we have all of this previous consolidation here. We have previous consolidation along with a huge level of imbalance here that's also at that key level. Perfect place to target. And then from there, again, so on and so forth, just like we talked about. You have the next key level that also lines up with this level of imbalance here. And then what happens? You have the ultimate highs of the day that would be run up here. Again, there's still imbalance here. And on other time frames, this is also an order block, understanding time and price theory, 945 or what, 940. So this would have been about to form a 5-minute candle. This is an order block on a different time frame. And just understanding that those are the places that you target. And this is how, again, you can run your 1 to 3 and secure, and then you can have your runner, which is ultimately going to get you what, maybe 1.5, 2% extra on the day, but you don't even care about that, because once you secure your bread and move your stop to break even, you don't really care. You can walk away for the day and let the chart do what it wants to do. And even here, again, just looking at this, again, we do know that this is hindsight, and we do understand that this is hindsight, but there's no other way to practice this other than hindsight. What do we see here? Even if you were to miss it, well, if you were to miss this entry, I technically wouldn't be trading, because again, this is already late in the day. But even if you miss this entry and you still wanted to look for the model happening, what happens? We run the highs here, we come back, we create this accumulation here that then turns to distribution. Once we break above the high, accumulation turn to distribution. And what happens? We break our high, next candle. First of all, this next candle comes down and mitigates it, which that could have been your original entry, but that's super fast, which is why I say at the end of the day, it can still start to work. But again, we're moving towards market close now, so it's a lot less prone for things to work out. Or not for things to work out, but for things to happen in a notable notion that you're going to be able to catch it. Again, this happens very, very fast. If you can catch this, kudos to you, but I wouldn't necessarily be looking for this, but it just shows how consistent it is and how it actually can work. Accumulation, turn to distribution, retest of the lows here, the exact place that you want to be retested, and then taking it again. You want to trade your original range. This is already a 1 to 5. And then let's say you want to target previous mitigation. Now you turn that into a 1 to 10. Simple, easy, in and out of the market. And this happens on literally a day-to-day basis, and you can go through, you can back test it, you can go and see for yourself, but it happens almost every single day, and almost the same exact setups happen day in and day out. But yeah, if you guys have any questions, just let me know. I'll probably be on for like another 3 to 4 minutes if you guys have any questions. But other than that, that's like the main thing that I wanted to break down for today. Again, this video will be recorded, and I suggest that you go back and if you really want to study this model and you're liking the way that it looks, go back and back test it. Again, we can't get better if we're not back testing, if we're not working. You can see it on the Zoom, I can explain it to you, but at the end of the day, you have to put it into motion in order for it to work, and you have to put in the work in order to see the progress. But yeah, if y'all have any questions, just let me know. I'll probably just chill here for like 3 minutes if y'all have anything to ask.
You took your trade on US 30. One of the reasons was because of the quarters theory. That's right.
Correct. Yes. So the US 30 trade this morning was this trade here. Don't pay attention here. I can even actually, just in case anyone's still looking at it, I'll just leave it on. But basically, I took this last trade here. So
yeah,
that last trade there, again, we have our quarter theory here. 33,250 is a key level. What happens once we get to that key level? We run our key level, inducing liquidity of the lows. We then have a bullish spike above that, turning this accumulation into now distribution. We also have wick levels that are holding here, showing that we don't want to show any more bearish price action. So that's where I got my entry here on that downside wick. And then again, I was targeting, I took my partials at 1 to 3, which was around the key level 33,500. And then my runner just ended up running the remaining risk to reward, which ultimately was 1 to 9R.
Gotcha. That's some good stuff, bro.
And it's so consistent. Like almost every single day it happens, and it happens multiple times throughout the day, especially again in that this is 11 this is 11:48. So these would have been your 2 identified trades if you were trading in the range. because this trade happens at 9:54 and this trade happens at 9:15. So these could have been two trades that would have run you full R in your 8 to 10 identified trading range, which is when this model most likely works. And again, this is 3R and this is 5.8R. So you're running like almost 10R in the day if you're catching both of these. But again, I need one a day. My 1 to 3 is perfectly fine. Once I hit 1 to 3 and take 70%, I can walk away from the day perfectly happy.
Of course, that's great. So when you say 8 to 10 Central Time?
Yes, 8 o'clock a.m. to 10 o'clock a.m. Central Time.
So that'll be like my 9 to 11 because I'm over here in Miami.
Are you Eastern?
Yeah.
So 9 o'clock to 11 for you, correct?
Gotcha. All right, cool. That's what's up. And real quick, I mean, since nobody else is asking the question, yo, the order block thing, I get that thing like really, really confused. You think you could brush me up on that?
All right. So basically, at the end of the day, all an order block is for a bullish order block is a downside move, let's not even mark this up. Let's just show you. So this right here is a bearish order block.
Yeah.
So you have a moving up candle that is now retraced by a down candle that takes at least 50% of the previous candle and leaves a form of imbalance behind. You understand the concept of imbalance, right?
Yeah, I got that.
Okay, so basically, again, just like we had just explained, so we have this up candle, this green up candle, followed by a bearish candle that takes at least 50% of that previous bullish candle, which also leaves this imbalance. And as you can see here, what does this imbalance do? This trade right here trades right into this order block, almost 50% of the order block before dropping off.
True.
And so that's what you're looking for with your order blocks. Again, we can look for a bearish order block as well. Let me look for one that gets mitigated. So this is a failed bearish order block here that then turns into a breaker. Again, this is just like when you start incorporating multiple things, you can see a lot of things. If an order block does not get held, then it most likely is going to turn into what's called a breaker block. And as you see, if you just move this over, price action reacts along that breaker block multiple times because it's just a failed order block literally just turns into a breaker block.
Gotcha.
But basically, that's what you're looking for. So for a bullish order block, you would be looking for a downside momentum candle, then followed by an upside bullish candle. So there's multiple here. This could be an order block here, a potential order block. Again, this gets ran because it wants to come and induce liquidity. If we measure this out here, 50%, this is an order block right here. So as you can see, we have a bearish candle, which then is presumed by a bullish candle that takes at least, hold on, let me adjust this. That takes at least 50% of the bearish candle. And then what do we see price action do? Come back and trade perfectly into our OB before actually taking off into the highs because the OB leaves in balance.
Gotcha.
So that's basically like the logistics of the order blocks. Again, they form on all time frames, and the higher time frame that you go on to, the more that they hold weight. Because again, those higher time frames are going to hold a lot more weight than those lower time frames are, which is why on the 1 minute you see all these potential order blocks that get failed that just turn into breaker blocks.
Gotcha. That's what's up, man. Thank you.
Yes, sir. Naomi, are you all good? Do you have any questions?
I don't have any questions. I'm just learning. Like I haven't started trading Forex yet.
Okay. Well, yeah, that is the main things for today. I don't want to overload too much. Again, just back test, looking at the real present market. Even if you aren't trading, like I say, I'm in the market 5 days a week. I might not be trading 5 days a week, but I'm in the market 5 days a week, whether that be studying, logging, back testing, anything. Like I'm looking at the market all 5 trading days minimum, and I'm usually looking at it on the weekends too, just to try and train my mind. The more that you look at these things, and the more that you see these things, and the more that you train your eyes to see these things, the more consistent it's going to become. And that's how you're going to eventually like start to see how your emotions are going to be taken away from trading. Because again, if you if you believe in something, then you're a lot less prone to be questioned about it. If you've seen something 100 times, if you back tested something 100 times and it's set in stone in your mind, again, what do we see? We see this. All right, we ran the lows. What happens here? I'm looking for an order once we get here because I'm expecting bullish PA. Boom, comes down, touches, and goes. Like, if you can get consistent and repetition, again, repetition is key. If you see the same things over and over again and you're trading the same things over and over again, the emotional aspect and the emotional attachment is going to slowly start to peel away, and you're going to be in that what 7 to 8% of traders who are actually profitable. But yeah, I will be sending, I'm going to try and send markups in the morning. Again, it's Tuesday, and I think we have news in the morning. Let me see what we have tomorrow. Have second. Okay, so we have no news tomorrow. So tomorrow is going to be a strictly PA day. We have no red news tomorrow, so strictly price action in the morning. But I will be definitely looking for potential setups, and if I see anything, I will try and send it y'all's way and let y'all know. Again, same thing happens over and over again on a day-to-day basis. You just got to try and train your eyes to it and look for it. Yeah, if y'all don't got any more questions, I'm gonna go ahead and head out. This is recorded. I should have this uploaded in probably like 15 to 20 minutes, and I'll drop it in the Telegram if anybody wants to go back and look at this video. But yeah, other than that, y'all have a great night.
You too, man. Thank you.
Yes,
Thank
sir.
you.
Of course. Of course.
Yeah, man.